All right. Hey, well, welcome to our first problem in managerial accounting. And see, before we jump in, I just wanted to kind of touch base at a real high level on kind of what we're going to focus on in this class. And so you guys just finished up with financial accounting. And so financial accounting, you're learning to do journal entries, prepare financial statements, and you're doing all of this. Your audience in financial accounting is people outside the company. It's going to be shareholders, it's going to be creditors, potential investors. It's people outside of the organization. And so because you're presenting these financial statements to people outside the company, we have FASB, who's created the Generally Accepted Accounting Principles, GAAP, in order to set the rules. And so, but in this class, we're actually be focused in managerial accounting on reporting within the company. And so we're not as concerned with specific rules as much as we are with information and how that information affects decision making. And so we have standard ways of doing certain things, but we're not necessarily operating by GAAP, because our end goal is not to follow certain rules, but it's to get information that's going to be valuable to us as a company and as managers. And so a lot of this is especially these first several chapters, we're going to be focusing on inventory and the cost of our product. And so one of the big things in managerial accounting is understanding what are our costs, how much does a product cost. And depending on how you look at things, you can come up with different numbers. So this is designed for us to really understand what the true cost of the company is. And so in this first chapter, we're going to talk about cost of goods manufactured. And so we're going to be dealing with two things. We have cost of goods manufactured and cost of goods sold. And so in financial accounting, cost of goods sold was a big part of what we calculated in order to put together an income statement. And so a cost of goods manufacturing goes along with that. It helps get us to our cost of goods sold. Essentially what it does is it tells us, hey, out of everything that we made, not counting sales at all, what was our cost to make this product that we build up in inventory. Whereas cost of goods sold, it's just that. It's like, out of what we actually sold and left the company, what was that cost? So, but we'll get into the schedule here and kind of work through this problem. So we're going to start off with problem 14-3. And so this is the exact problem in your homework. I think that the numbers might they might be more dynamic, so then the numbers might change, but the problem itself is going to be the same problem. So the intent of this, all these videos that we'll be doing, is just to pick the hardest problem in the homework and just walk through it together step by step, just so it's clear. So. I don't want you guys to sit here and struggle with the homework. I want you guys to be able to learn from it. So all right. So we will jump in here, and problem 14-3. It says, so we're going to use some data from 14-2, and we're going to prepare a cost of goods, a statement, or schedule of the cost of goods manufactured. So, all right, so we have some inventory balances here, beginning and ending, then we have some other expenses down here. And so one thing that we're going to be talking about as far as like terminology is usually a company has three different kind of inventory accounts. The first is a raw materials inventory, the second is a work in progress, and the third is finished goods. And so what those are, so a raw materials inventory is just, let's say we have a company that builds, picnic tables. So we have wooden picnic tables. And so as we're buying wood to build those, that raw lumber, we're going to record that as inventory, and that's going to be our raw materials inventory. It's not anything close to our end product, but it's still stuff that we buy that's going to turn into our end product. The next is a work in process inventory, and so that's the stuff that we've started to work on. So that's our half-finished picnic tables at the end of each month. And so that's going to involve different kinds of costs. That's going to have our lumber, that direct materials. It's also going to have, we're going to put labor into that to start transforming that wood into a picnic table. And then we're also going to allocate overhead to that cost. And so overhead is just kind of the miscellaneous cost that you can't, specifically, in detail, like really easily tie back to the product, but it's still related to the product. And so a lot of that might be, so you have a factory supervisor, and so his salary is going to go towards the product, but it's hard to say, hey, this one picnic table, gets 3% of his salary or something like that. So, it's going to be stuff that's just going to be just a little bit more general. So anyway, let's just jump in and start going through it. All right, so in this problem, so we have the information for Leon Company to complete the requirements. Assume the income tax is $233,725. We'll get to that later. And then it gives us information. We have our inventories here. And so on our schedule of goods manufactured, we want to start off, we're going to look at the direct material costs, we're going to look at the direct labor costs, and we're going to look at overhead. So the first thing is we want to figure out, hey, how much raw materials did we start the year with? What's our beginning balance? And so it gives us that right over here as 166,850. Then, okay, how much did we purchase during the year? And so our purchases are going to be down here. So raw materials purchases 925,000. All right, and we have a subtotal here. So we have just a little over 1 million available raw materials available to use, and then we're going to subtract out our ending balance, which is the 182,000 that gets us the direct materials that we actually used. So the next is direct labor. And so our direct labor is given to us down here at 675,480. Alright, so now we've accounted for the raw material, the direct labor. So the direct labor is going to be the people with their their hands on the product, actually transforming our wooden picnic tables. Oh, so the next thing is our overhead. And so our overhead, that's kind of like the miscellaneous stuff. It's related to the product, but it's hard to tie exactly to the product here. And so the first thing, we'll do depreciation expense for the factory equipment. And that's going to be $33,550. And we have factory supervision, $102,600. And we have factory supplies used. It's going to be $73,50. And then our factory utilities is $33,000. Indirect labor is $56,875. Our miscellaneous production cost, let's see, it's right here. That's going to be our $84.25. Our rent expense on the factory building, factory, that's $76,800. Okay, and so So the difference here, so it gives us like 3 different rent expenses here. So we have our office space, we have a selling space, and a factory space. And so we want stuff that's going to go into overhead. So that's going to be stuff that's going to be essentially, closer related to the actual product. And so, the office space and selling space, that's going to be your selling and general administrative expense, which is not part of your product cost. So that's, if you remember back to financial accounting, that's not going to flow into your cost of goods sold. That's going to be part of your operating expenses that are lower down on your income statement. And so we just want stuff that's related to the production of our product. And so the next one, we want maintenance expense related to the factory. So that's going to be $35,400. And so that gives us total factory overhead cost of $354,000. Total manufacturing cost of $1.93. And so that's the cost we incurred during the period. So now we just need to take into consideration our work in process inventory. So we had a beginning balance of work in process inventory of $15,700. And we had an ending work in process of $19,380. So even though we spent all this money on raw materials and overhead and labor, some of that we didn't actually finish the product. It was still sitting there, so we have to take that out. And so that gives us a total cost of the goods that we manufactured during the month of $1,935,650. And so they give us a nice little check figure over here. And so that matches, so we got it right. And so, excuse me. So the cost of goods manufactured, like I said, it's not the cost of goods of sold. It's the cost that we made. So whether we sold it or not, it doesn't matter. This is just the cost that was related to our manufacturing process. All right, so number 2, it says prepare the company's income statement and report separate categories for selling expenses and general administrative. Okay, so we'll go down here. And so our income statement, we start off with sales. And so our sales are given to us right here at $4,462,500. And now we're going to calculate our cost of goods sold. And so instead of plugging one number in, we'll actually kind of do the calculation within the income statement here. And so we want the finished goods inventory for the beginning of the year. And so that's going to be the $167,350. And then we want to add in our cost of goods manufactured, which we calculated above. So that gives us our total goods available for sale. And we want to subtract out our finished goods inventory at the end of the year. So that was $136,490. So that's going to give us a cost of goods sold of $1,966,510. And then gross profit is just our sales minus our cost of goods sold. And so now we can plug in our advertising, all our operating expenses. So we had selling or advertising expense of $28,750. That's up here. And so we have our depreciation related to our selling equipment, not the manufacturing equipment, because that was up in our cost of goods sold. $8,600. Our selling expense, $26,100. And our sales salary of $392,560. Now we have our depreciation related to office equipment. So we had that above at $72,50. Office salaries expense, $63,000. And then office space rental, $22,000. That gives us our totals here. The only thing we have to plug in is our income tax expense, which we don't have to calculate because they give it to us up here at $233,725. So that's going to give us a net income of $1,714,005. Not too bad. So we're not doing a lot of calculations. They're giving us a lot of the numbers, just knowing where to put those numbers. All right, and so the part 3. So it wants us to compute inventory turnover and tells us how to calculate that. Days sales and inventory. Okay, and it wants us to do that for both our raw materials inventory and our finished goods inventory. And so these numbers we've already calculated. So our cost of materials used, we calculate that up here at $909,850. Let's just do all the raw materials, then we'll do all the finished goods. And so then we have our beginning inventory of raw materials up here. We want our ending inventory of raw materials. And so it's just asking us here, so the beginning plus the ending, that'll just help us with our calculation. So we'll just add those two up. And so we'll calculate the average inventory. So our average inventory, so that's just the total that we just added divided by 2. And then we want our inventory turnover. So that is just going to be defined by our cost of raw materials divided by our average inventory. And so inventory turnover, so that means we turned over that inventory 5.2 times throughout the year. Or we bought raw material. Maybe we made 5 orders of raw materials throughout the year. And so one number isn't. You can't just look at a number and say, "Hey, this is good" or "This is bad." The key is looking at the number within context. So, for the example, you want to sell your inventory, as quickly as possible. So you want that number to be, to be as low as possible. And so this could be a good number, and this could be a bad number. It just depends on the circumstances. For example, if, over the last, 8 quarters, maybe that number has gotten, a little bigger and a little bigger. Maybe it started off at 3, 3.5, 4, and just kept growing. So that'd be a bad sign that it's growing. I'm sorry, I said that backwards. We want that number to be high because we want to turn it over. So if it was growing, that would be a good thing. That would mean that we're buying inventory, or buying raw materials, and we're selling it, we're producing it, we're moving it. What would be bad if that number actually got low and then that means that we're buying it, but we're holding on to it for a long time. And so turnover is a good thing. Turnover, you want the high number. And so the days, so days sales in inventory. So we want to take our ending inventory balance, divide that by our cost, and then multiply that times 365. So what that's saying is that our ending inventory balance is going to last us for 73 days. And so that could be, like I said, a good thing or a bad thing. It kind of depends on how much you want to keep in stock. You don't want to have too much inventory on hand, but you also don't want to run out. And so depending on kind of what your circumstances are, as far as, maybe there's like a really long lead time to buy this material. So you want to make sure that you have enough. If you had to reorder, that you'd have enough to get you through. But you also don't want to have more than you need. So let's go ahead and look at finished goods. And so for finished goods, we're going to look at our cost of goods sold, which is calculated up here. And we'll get our beginning finished goods. Up here. And our ending finished goods here. Add them together. So to get our average finished goods inventory, just take our total there divided by 2. So just divide our cost of goods sold by our average inventory. And so here we have a higher number. So what that means is we're actually turning over our finished goods faster and faster than our raw materials. And so that's generally a good thing, that we're moving it. But depending on your inventory balance, it also means you could sell out of your goods and not have enough inventory. So in this case, maybe it makes sense that if you have a lot of you're turning over your finished goods a lot, that you keep a lot of inventory, days of inventory on hand, so you can kind of keep up with that. But like I said, it's a lot of it's just context. And so we want our days. Oops, that's backwards. There we go. And so the days sales and inventory. So that basically what that means is in our ending inventory of finished goods, we have enough to last us for 25 days. So we could go almost one full month to go through that. And depending on what your manufacturing process is, that might be really good, or that might be really low. So it's more of kind of the context, like what makes sense. And usually these numbers make more sense when you look at it over a long period of time. Okay, so it says discuss some possible reasons for these ratios. Okay, so this is kind of what we've been doing, just kind of talking about what these numbers mean. Whether they're they're good or they're bad. It probably what it looks like here is you have days in inventory. So this is probably something like a long lead time item, sometimes you just can't, order it and have it, have it show up like Amazon Prime and show up in 2 days. Maybe you have to order this stuff from overseas and it takes a while, and it takes, 2-3 months to get your stuff in. So in that case, you have to carry, a lot more inventory, or maybe it makes sense to buy large quantities. Sometimes you get, a discount if you order, 100,000 of it versus, 1,000. You might get a lot better price. And so from that perspective, it might make, really good sense to go ahead and have a lot of inventory in stock, because you get that better deal. But there's risk to it too. Is maybe you have something, maybe you have a perishable good where this stuff spoils and it goes bad, and so in that case, that might be kind of dangerous to have too much on hand. You might lose a lot, or maybe it's something in a technology field that you have to worry about obsolescence. There could be something raw materials or something that's you're not using enough, you're not using anymore, and so you might get stuck with this on your books. And so it really, numbers by themselves don't mean anything. It's what do they represent and what trends are they showing. So it's all about, for managerial accounting, it's all about context. All right, well, I think that wraps up our problem 14-3.